Well, that we are off to the races. Trading is officially underway here at the New York Stock Exchange. And to talk more about the markets and the current investment landscape under the Trump administration is Tim Urbanowicz. He is the Chief Investment Strategist at Innovator at Capital Management. Tim, it's great to have you in studio. Thanks for joining us on the show.
Great to be with you, Trinity.
So we just opened up the U.S. equity markets right now. What are we looking at? Paint us a broad picture.
Well, I think overall, we've remained very constructive on U.S. equities. We think the economy is going to hold up, which should continue to propel earnings. We just came off a very strong earnings season here. We think that is going to continue. But I think you also have to be conscious of the fact that it is very fragile. And that fragility really comes with where valuations are. If we look at the market right now, by no stretch of the imagination are things cheap. And that doesn't necessarily mean that we have to sell off, but it does make this market much more sensitive to any news that is contrary to a lot of the animal spirits that have been pushing this market ahead.
And a lot of tariffs obviously are at the forefront of conversations, especially here on Wall Street. Investors are anticipating what's going to happen. How should investors balance the trade-off between Trump's pro-growth policies and the uncertainty tariffs also bring to the market?
Well, I think with tariffs, first of all, investors need to take Trump seriously on those. I don't think if we look out there broadly, those are priced in right now. He says he's going to do it. I think there's this mindset that, he's pro-economy, pro-stock market. At the end of the day, he's going to implement these, and we have to take that seriously. That said, if we look at all the different policies as a whole, we do think that there's still a slight positive for the market, positive for the economy overall. If we look specifically at the deregulation piece, we're going from an administration where the cost of regulations were extreme. They were very, very high. Now we're going to the opposite extreme with Trump. The tax cuts could also be very positive. But there is this trade-off, and I think it's going to be this tug of war. It's not just going to be up and to the right all year. I do think that you're going to see quite a bit of volatility as investors digest this balance of news.
And the Fed minutes also will come out later on this afternoon. What do you think should be top of mind for investors? What are you looking out for?
Well, I think you need to put rate cuts this year behind us. I would not be surprised if, in a couple months from now, we're talking about a potential hike. What we have seen is that really inflation expectations have kicked up all year long as the Fed has cut rates, and I think the bond market has clearly been saying we do not want the Fed cutting. It is worrisome for the fact that that has the ability to reignite inflation. We don't want to see that. The Fed needs to be on hold here. We expect that. We think that Chair Powell is going to continue to remain on hold here and be in wait and see mode. The inflation data recently has not been heading in the right direction.
Yeah.
If you look outside of housing, the core services, core goods, those are all ticking up. That's not what we want to see, so we need to pause here, and I think the bond market will applaud that.
And I do want to talk to you in efforts to contain federal outlays. If that succeeds, how significant will the long-term impact be on the broader market?
I think it's huge, and I think specifically if you look over the last couple of years, we've had this bifurcation where high-end consumers have been doing well, low-end consumers have been struggling just to get by, and that a big piece of that has to do with the price increases that we've seen. And if we trace those back, where are those stemming from? It's stemming from these extreme government outlays that we've seen post-pandemic. So I think the big question for me right now, Trinity, is are they going to be successful in pulling spending back enough? I think it's going to be difficult, not as easy as it may seem, but if they are successful, if you have DOGE that is successful, be able to cut headcount, cut costs, ultimately, we think that reins in longer-term inflation expectations, which will be an overall positive for the market, and also make the use of labor more efficient. If you look at a lot of these government employees that are potentially getting laid off or have already been laid off, reallocating those to the private sector, we think that's going to also boost productivity.
And with deregulation and tax cuts benefiting various sectors, what industries do you think will benefit the most?
Well, I think the ones that have been bogged down the most. We think about energy stocks. They struggled big time over the last 4 years with all the regulatory burdens, a lot of those being rolled back, specifically a lot of the clean and green regulations. And then also financials. Specifically, we think about like smaller regional banks. Those compliance costs, those regulatory burdens are real, right? And to be able to roll those back, we think really benefits those sectors in a pretty big way. So we want to make sure that we have exposure to those pockets of the market right now.
And interest rates remain a key driver. If the 10-year yield stays above about a 4.25%, what do you expect for equity valuations and investor sentiment?
Well, there's a big difference from the level of where the yield starts at. Okay, if we see rates increase and we have the 10-year north of 4.5%, equity markets are not going to like that. You're going to see valuations take a bigger hit there. It's actually what we've seen over the last couple of years. Moves higher when we're above 4.5%. Not good. We get below that level, you start to see less of an impact. And then if we were to ever see a situation where we get above that 5% mark on the 10-year, expect huge compression of those multiples when interest rates rise. But I think bottom line for investors right now, interest rates are in the driver's seat. So when we look at the portfolio as a whole, we have to disconnect any reliance on interest rates having to come down to be managing risk in our portfolio. They're a key driver of the equity side. They're going to be a key driver of the bond side. Same thing with defensive sectors, defensive stocks. We need to be cautious on that right now.
What else should investors be on the lookout for the rest of this year?
I think it's going to, it's going to continue to be a market that is driven by the Trump administration. I think small caps are a place that's been underloved and underserved over the last several years. So, take a look at those. You look at the relative valuations, much lower. Doesn't necessarily mean that those small caps will do well. But if we continue to see earnings growth kick up, you see good news, those valuations are going to act as a spring and really give us a lot more upside potential off that starting point.
It was a pleasure speaking with you again, Tim Urbanowicz, Chief Investment Strategist at Innovator Capital Management. Thank you for joining us.
Thank you.